Before we dive in, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or real estate agent. The information provided in this video does not constitute financial, legal, or real estate advice. Real estate markets, interest rates, and lending requirements are subject to constant change and vary significantly by location. You should always consult with a qualified and licensed professional before making any major financial decisions. Let's talk about a number that sounds like a myth in today's housing market. A number so small, most people living in a major U.S. city would laugh if you said it was the price of a house. That number is $80,000. You've seen the headlines, you've scrolled through Zillow with a growing sense of dread. You see starter homes listed for $500,700,000, even $1 million. You hear the stories of insane bidding wars, of people waiving inspections, of paying $50,000 over asking price for a house that needs a new roof. And it's easy to feel like the dream of owning a home, that cornerstone of American life, has been pulled out from under you. It feels like you're permanently locked into the cycle of renting, where your monthly payment builds someone else's equity, not your own. What if I told you that the American dream isn't dead? It just moved to a different zip code. What if I told you that in dozens of cities and towns across the United States, an $80,000 mortgage isn't a fantasy? It's a reality. It's the key that unlocks a front door you can call your own. This isn't about some tiny home on wheels or a dilapidated shack in the middle of nowhere. This is about real houses in real communities where you can build a life. Over the next few minutes, we are going to completely demystify this. We're not just going to talk about it, we're going to break it down piece by piece. We're going to show you exactly what an $80,000 mortgage looks like, what the monthly payment actually is, who qualifies for it, what kind of credit score you need, and most importantly, where in America this is still possible. By the end of this, you will have a clear, actionable roadmap. You will understand the math, the process, and the mindset required to turn what sounds like an impossible number into your home address. So let's get one thing straight. An $80,000 mortgage is not for everyone. If you're determined to live in downtown San Francisco, Austin, or New York City, this isn't the path for you. This is for the person who values financial freedom over big city amenities. This is for the remote worker, the young family just starting out, the individual tired of pouring their paycheck into a landlord's pocket. It's for the person who wants to own their home outright in 15 years, not 30. It's for the person who wants their biggest monthly expense to be manageable, predictable, and, dare I say, small. It's a strategy. It's a choice to prioritize stability and ownership over location hype. When you get a mortgage, your monthly payment isn't just one number. It's a bundle of 4 different costs, and the acronym you need to burn into your brain is PITI. That stands for principal, interest, taxes, and insurance. Understanding these 4 letters is the absolute key to understanding any mortgage, whether it's for $80,000 or $8 million. Forget everything else for a moment. PITI is the foundation. So let's start with the first 2, the big ones, principal and interest. Principal is the easy part. It's the amount of money you actually borrowed. In our case, it's $80,000. Every time you make a payment, a portion of it goes to chipping away at this $80,000 mountain until it's gone. Interest is the price you pay for borrowing the money. It's the lender's profit. It's expressed as a percentage, the interest rate, and right now, rates have been hovering in the 6% to 7% range for a qualified buyer. This percentage might seem small, but its impact over the life of a loan is massive. Let's do the math right now. Let's take our $80,000 loan and assume you get a 30-year fixed-rate mortgage with a 7% interest rate. Plug that into a mortgage calculator, and your monthly payment for just the principal and interest, remember we haven't added taxes and insurance yet, comes out to approximately $532 per month. $532. Pause and think about that. How much is your rent right now? For millions of Americans, that number is less than what they pay for their car payment. It's less than what many people spend on groceries or going out to eat in a month. This is the first powerful realization. The core cost of financing an $80,000 home can be incredibly low. Now, what if you wanted to be more aggressive? What if you wanted to own your home free and clear twice as fast? Let's look at a 15-year fixed-rate mortgage. The interest rates on 15-year loans are often slightly lower, so let's use 6.5% as our example. For the same $80,000 loan, your monthly principal and interest payment on a 15-year term would be about $700 per month. Yes, it's about $170 more each month. But here's the magic. Over the life of that 15-year loan, you would pay a total of about $46,000 in interest. On the 30-year loan at 7%, you would pay over $111,000 in interest. By choosing the shorter term, you save yourself $65,000. You save almost the entire original value of the house in interest payments just by paying it off faster. You build equity at lightning speed and you are completely debt-free in half the time. This is the power of understanding the math. It's a choice between a lower monthly payment and a much lower total cost. But how does this actually work? When you make that $532 payment on your 30-year loan, it doesn't get split evenly. It's not $266 to principal and $266 to interest. The bank pays itself first. This process is called amortization. In the beginning of your loan, the vast majority of your payment is pure interest. For that very first payment of $532, only about $65 goes towards paying down your $80,000 loan. The other $467 is pure profit for the bank. Can feel discouraging. Feels like you're running on a treadmill. But every single month that balance shifts. The next month a tiny bit more, maybe $66 goes to principal. And the month after that, a little more. Over years this slowly tips in your favor. By the last few years of your loan, almost your entire payment is going towards principal, and you're just crushing the remaining debt. This is why making even one extra payment a year, especially early on, can have such a dramatic effect, shaving years and thousands of dollars in interest off your loan. So we've figured out the P and the I, the principal and the interest. For a 30-year loan, we're at $532 a month, and it feels incredibly achievable. You might be thinking, okay, I can do that. Sign me up. But hold on. That number, as attractive as it is not the whole story. It's not the number you'll actually write the check for each month. We're missing the other two silent partners in your mortgage payment. The two letters that can sneak up on you and completely change your budget if you're not prepared. I'm talking about the T and the I, taxes and insurance. These two expenses are not optional, and they vary wildly from one street to the next. And they are the single biggest reason why just looking at a principal and interest payment can be so dangerously misleading. Let's talk about a woman named Sarah. Sarah had been saving for years, meticulously putting away every extra dollar. She finally had enough for a down payment on a small charming house she found on Zillow. The listing price? $100,000. After her $20,000 down payment, she was looking at an $80,000 mortgage. She plugged that number into an online mortgage calculator. With a good interest rate, it spit out a monthly payment of around $410 for principal and interest. $410. She was paying 3 times that for her tiny one-bedroom apartment. This was it. This was her chance to finally own something, to build equity, to paint a wall whatever color she wanted without asking a landlord. She was ecstatic. She called the agent, toured the house, fell in love, and put in an offer. Everything was going perfectly. And then a week later, she got the official loan estimate from her lender. She scanned down the document, her heart pounding with excitement, until her eyes landed on the estimated monthly payment box. Her breath caught in her throat. The number wasn't $410. It was $750. Her stomach dropped. That was an extra $340 a month. That was the difference between comfortably affording her home and being house poor, constantly stressed about money. What happened? Where did this huge extra cost come from? Sarah had been blindsided by the two most misunderstood components of a mortgage payment: property taxes and homeowner's insurance. Let's start with the T taxes. Property taxes are, in simple terms, your subscription fee for living in a civilized society. They are what your local government, your city, your county, your school district, charges you to pay for things we all rely on. We're talking about public schools, police and fire departments, road maintenance, libraries, and local parks. When you own a piece of land, you are required to chip in for the services that make that land valuable and safe. It is not optional. If you don't pay your property taxes, the government can and eventually will take your house. So how are they calculated? It's a bit of a two-part equation. First, your local government figures out the assessed value of your home. This is not the same as the market value or what you paid for it. It's what the tax assessor's office says your property is worth for tax purposes. Then they apply something called a millage rate, or a tax rate, to that assessed value. A mill is equal to $1 of tax for every $1,000 of assessed value. So if your home is assessed at $100,000 and the total millage rate is 25 mills, you'd owe $2,500 a year in property taxes. Divide that by 12, and you've got an extra $208 added to your mortgage payment every single month. Now here's the critical part, the part that ambushed Sarah and so many others. This rate varies dramatically depending on where you live. Not just the state, but the county, the city, and even the specific school district. This is why a $100,000 house in one town can have a completely different tax bill than an identical house just 10 miles down the road. For example, the average effective property tax rate in New Jersey is over 2%. In Illinois, it's right around 2% as well. On our $80,000 mortgage example, assuming a $100,000 home value, that could mean $2,000 a year, or about $167 a month. But in a state like Alabama or Hawaii, the average rate is less than 0.5%. That's less than $400 a year, or about $33 a month. That is a massive difference. We're talking about a $134 swing every single month on the exact same priced house, just based on the state you choose to live in. And even within a low-tax state, a property in a major city with a highly funded school district will have a much higher tax bill than a rural property in a different county. This is the number one variable that online mortgage calculators get wrong, because they can't possibly know the specific tax rate of the exact property you're looking at. Next, let's talk about the insurance. Homeowner's insurance is another non-negotiable expense. If you have a mortgage, your lender will require you to have it. And frankly, even if you didn't have a mortgage, you'd be crazy not to have it. Why? Because the bank has invested $80,000 in your home. They need to protect that investment. If your house burns down in a fire and you don't have insurance, their $80,000 asset is now a pile of ash. They lose everything. But more importantly, you lose everything. Homeowner's insurance protects you from financial ruin in the event of a disaster. A fire, a tornado, a major hailstorm, a burst pipe that floods your kitchen. It also provides liability coverage. If the mailman slips on your icy porch, breaks his leg, and decides to sue you, your homeowner's insurance is what protects your life savings. Just like property taxes, the cost of insurance is all about location and risk. Insuring a home in central Kansas, right in the heart of Tornado Alley, is going to cost more than insuring that same home in a quiet part of Utah. Insuring a home on the coast of Florida or Louisiana, with the constant threat of hurricanes, is going to be astronomically more expensive. We're talking thousands and thousands of dollars a year in some high-risk zones. In fact, in some areas of Florida and California, with hurricane and wildfire risk, it's becoming difficult to get insurance at all. But it's not just about geography. Insurers look at the specific house. How old is the roof? A brand new roof can get you a discount. A 25-year-old roof is a huge red flag. What kind of wiring does it have? Old knob and tube wiring can make a home uninsurable for some companies. Do you have a swimming pool or a trampoline? Those are attractive nuisances that increase your liability risk, and therefore, your premium. Is the local fire department a full-time professional crew just a block away? Or is it a volunteer station 20 minutes down a country road? All of these factors are meticulously calculated to generate your insurance premium. For a typical $100,000 home in a low to medium risk area, you might expect to pay anywhere from $50 to $150 a month. For Sarah, her quote came in at about $85 a month. So let's do the math for Sarah again. Her principal and interest was $410. Her property taxes in a mid to high tax area were about $165 a month. Her homeowner's insurance was $85 a month. Suddenly, her real payment isn't $410, it's $660. Still better than her rent, but a far cry from the dream number she saw online. But wait, how does this actually get paid? The bank doesn't just trust you to save up $2,000 for your tax bill that's due in November. This is where a crucial concept comes in, the escrow account. Think of escrow as a mandatory savings account managed by your mortgage lender. Each month when you make your mortgage payment, a portion of it is for your principal and interest, and the rest is for your taxes and insurance. The lender takes that T&I money and puts it into your escrow account. Then when the property tax bill and the homeowner's insurance premium are due, the lender pays them for you on your behalf, using the funds from that account. It's a system designed for forced savings to ensure those critical bills get paid, protecting both you and the lender. This is why Sarah's monthly payment was so much higher. The lender wasn't just quoting her the loan repayment. They were quoting her the full, all-inclusive monthly housing costs they would be collecting. Understanding this, that your true payment is PITI, not just P&I, is the first giant leap toward becoming an educated homebuyer. It transforms you from a dreamer looking at Zillow into a serious contender who understands the real-world costs. But here's the scary part. For many people, especially those with smaller down payments, PITI isn't even the final number. There's another letter, another acronym, that can inflate your monthly payment even further, sometimes by $100 or more. It's an expense that provides zero benefit to you, the homeowner, and yet millions of Americans are forced to pay it. It's the final and often most frustrating piece of the core mortgage puzzle. This hidden cost is called private mortgage insurance, or PMI. And if you've ever wondered why it's so hard to buy a house with a small down payment, this is the reason. PMI is the gatekeeper of the American dream for millions of people. But here's the secret that lenders don't exactly shout from the rooftops. PMI doesn't protect you. It doesn't protect your family if you lose your job. It doesn't rebuild your house if it burns down. Private mortgage insurance protects one entity and one entity only: the bank. It is an insurance policy that you are forced to pay for, that covers the lender's losses in case you stop making your payments and they have to foreclose on you. Think about it from their perspective. For decades, the gold standard for buying a home was putting 20% down. On our $80,000 house, that's $16,000 in cash. When a buyer puts that much of their own money into the deal, the bank sees them as a safe bet. They have significant skin in the game. They're highly motivated to make their payments because they don't want to lose their $16,000 investment. But what happens when someone doesn't have that kind of cash? What if they only have $3,000, $4,000, or $5,000 saved up? From the bank's point of view, that's a much riskier loan. If that buyer defaults early on, the bank could lose a lot of money after going through the expensive and lengthy foreclosure process. So they came up with a solution. They said, okay, we'll give you the loan with a smaller down payment, but you have to buy an insurance policy for us. You pay the monthly premium. And if you default, this insurance company will pay us back a portion of our losses. That is PMI. It's the fee you pay for the privilege of not having a 20% down payment. It's a risk tax. And it gets tacked right onto your monthly mortgage payment, inflating that PITI number we've been carefully calculating. Let's see how this plays out in the real world with our $80,000 home. Let's say you've managed to save up 3.5%, which is the minimum for a popular first-time homebuyer loan called an FHA loan. 3.5% of $80,000 is $2,800. That is a dramatically more achievable goal than $16,000. You give the seller your $2,800. That means your starting loan amount from the bank is $77,200. Because you put down less than 20%, your lender now requires you to pay for mortgage insurance. The cost of this insurance is calculated as a percentage of your loan amount. It can range anywhere from about 0.5% to nearly 2% per year, depending on your credit score, your down payment size, and the type of loan you get. Let's be conservative and say your PMI rate is 1% per year. We take your loan amount, $77,200, and multiply it by 1%. That gives us $772 per year. Divide that by 12 months and you get $64.33. Every single month, you'd have to pay an extra $64 that does absolutely nothing for you. It doesn't pay down your loan. It doesn't build your equity. It's just gone. It's a fee paid directly to an insurance company to make your lender feel safe. Over a year, that's over $770. Over 5 years, it's nearly $4,000. That's more than your entire down payment, vanished into thin air. But wait, because it gets even more complicated and, frankly, more expensive. The example I just gave is for a conventional loan. If you're getting that FHA loan I mentioned, which is incredibly common for homes in this price range because of its flexible credit requirements, you don't pay PMI. You pay something called MIP, or mortgage insurance premium. It sounds similar, but the difference is absolutely critical. FHA's MIP is a two-headed monster. First, there's the upfront mortgage insurance premium. This is a one-time charge that, as of today, is 1.75% of your loan amount. So, on our $77,200 loan, that's an extra $1,351. Now, most people don't pay this in cash. Instead, it gets rolled right into their mortgage. So your loan amount isn't $77,200 anymore. It's now $78,551. You're now paying interest on your mortgage insurance for the next 30 years. But that's only the first head of the monster. You also have to pay the annual mortgage insurance premium, which is paid monthly. For most FHA loans, this rate is currently 0.55% of your loan balance per year. So we take our new, higher loan amount, $78,551, and multiply it by 0.55%. That gives us $432 per year, which breaks down to $36 per month. Now you might be thinking, $36? That's better than the $64 from the conventional loan example. And on the surface, you'd be right. But here is the soul-crushing catch that has cost American families billions of dollars. With a conventional loan, once you've paid down your mortgage to the point where you have 20% equity in your home, you can call your lender and ask them to remove the PMI. By law, they are required to automatically remove it once you reach 22% equity. The $64 fee eventually goes away. With an FHA loan, if you put down less than 10%, that $36 monthly MIP payment is for the entire life of the loan. It never goes away. You could live in that house for 29 years, have it almost entirely paid off, and you would still be forced to pay that $36 mortgage insurance premium every single month. The only way to get rid of it is to sell the house or refinance into a conventional loan, which comes with its own set of costs and hurdles. It is a financial trap, plain and simple, and it's the price you pay for the easier entry that an FHA loan provides. So let's put all the pieces together. Let's build our final true monthly payment for this $80,000 house, assuming we use an FHA loan. First, principal and interest. Our loan amount is now $78,551. At a 6.5% interest rate over 30 years, our principal and interest payment is $496 a month. Next, taxes. We estimated 1% of the home's value per year, which came out to $100 a month. Then homeowner's insurance. We estimated a conservative $60 a month. And finally, our new friend, the FHA mortgage insurance premium, which we calculated at $36 a month. Add it all up. $496 plus $100 plus $60 plus $36. Our grand total, the true PITI plus MIP payment, comes to $692 per month. Now take a step back and look at that number. $692. Is that a lot? Well, what's the rent for a comparable 2- or 3-bedroom house in the area you're looking? Is it $800? $1,000? $1,200? Suddenly $692 to own your own asset, to build equity, to paint the walls whatever color you want, to have a backyard for your dog. It starts to look like the best deal in town. This is the entire calculation. This is the math that millions of Americans do every year. They weigh the frustration of paying for things like mortgage insurance against the soaring cost of rent and the freedom of homeownership. This number, $692, is the core of what an $80,000 mortgage truly looks like month to month. But this is only your ongoing cost. The battle isn't over, because getting to the point where you can even start making these monthly payments requires you to get through what is often the most stressful and expensive part of the entire home buying process. The down payment is just the cover charge to get into the club. The real pain comes from the thousands and sometimes tens of thousands of dollars in fees you have to pay just to sign the paperwork. These are the infamous closing costs, and they are a minefield of hidden expenses that can completely derail your dream of buying a home. So let's walk through that minefield together. On average, closing costs in the United States run anywhere from 2 to 5% of the total loan amount. For our $80,000 mortgage, that means you need to be prepared for a bill that could be anywhere from $1,600 to $4,000. And that's on top of your down payment. This is the number that shocks first-time homebuyers. It's the unexpected gut punch right at the finish line. So where does this money go? It's not just one giant fee. It's a swarm of smaller individual charges, each with a specific purpose. And your guide through this swarm, your map through the minefield, is a document you'll receive from your lender called the loan estimate. This 3-page form is legally required, and it breaks down every single anticipated cost. When you get this document, don't just glance at it. Study it, live with it, understand it, because every dollar is accounted for right there in black and white. Let's break these costs down into 3 main categories. First, you have the fees the lender charges you directly for the service of creating your loan. Second, you have the fees for third-party services that the lender requires to get the deal done. And third, you have the money you have to prepay for things like taxes and insurance. Let's start with the lender's cut, the loan origination fees. This is what you're paying the bank for their work, their risk, and their profit. The biggest line item you'll see here is often called the origination fee, or points. Think of this as the lender's main commission for creating the loan. Point is simply 1% of the loan amount. So 1 point on our $80,000 loan would be $800. Lenders might charge anywhere from 0 to 1 or even 2 points. Sometimes you can choose to pay more points up front in exchange for a lower interest rate over the life of the loan. This is called buying down the rate. For an $80,000 mortgage, the math on whether that's a good deal can be tricky, but it's a conversation you must have with your loan officer. Next to the origination fee, you'll see a list of smaller, itemized charges. These are the administrative costs. You might see an application fee, which can be $100 or more, just for submitting your paperwork. There's the underwriting fee, typically a few $100s. Underwriting is the process where the lender verifies all your financial information, your income, your assets, your debt, your credit score, to officially approve you. Think of it as the cost of hiring a financial detective to make sure your story checks out. Then there's a processing fee, another couple $100s for the clerical work of gathering documents and putting your loan package together. These fees, origination, application, underwriting, processing, are all going directly into the lender's pocket. They are the cost of doing business with that specific bank. Now for the second category, and this is where the list gets really long, third-party fees. These are costs for services performed by other companies, but they are required by your lender to protect their investment. You don't get to skip these. First up is the appraisal fee, usually between $300 and $500. The lender needs to know that the house you're buying is actually worth the $80,000 they're lending you. So they hire a licensed, independent appraiser to inspect the property, compare it to similar homes that have recently sold in the area, and determine its fair market value. This protects the lender. If you default on your loan and they have to foreclose, they need to know they can sell the house and get their money back. But it also protects you. You don't want to be the person who pays $90,000 for a house that's only worth $70,000. The appraisal stops that from happening. Next, a smaller one, the credit report fee. It's usually only about $30 to $50, but it's mandatory. The lender has to pull your credit history from the 3 major bureaus, Equifax, Experian, and TransUnion, and this is you reimbursing them for that cost. Now for a big one, and probably the most confusing of all, title services. You'll see a whole cluster of fees here: title search, lender's title insurance, and settlement fee, which can add up to over $1,000. So what on earth is title? Title is the legal concept of ownership. When you buy a house, you are buying its title. A title search is when a company digs through decades of public records, deeds, mortgages, wills, divorce decrees, to make sure the person selling you the house actually has the legal right to sell it, and that there are no outstanding claims or liens against the property. You don't want to buy your dream home only to have a long-lost cousin of the previous owner show up with a valid claim to the property. That's where title insurance comes in. The lender's title insurance policy is mandatory. It protects the lender's $80,000 investment against any future title problems. There's also an owner's title insurance policy, which is usually optional but is something you should almost always get. It protects your investment, your down payment, and your equity for as long as you own the home. It's a one-time fee paid at closing, and it can save you from financial ruin down the road. Also in this third-party bucket, you might see a survey fee, if the lender wants a precise map of the property lines, and a flood certification fee, to determine if the home is in a flood zone. And finally, you'll pay the settlement or closing fee. This is paid to the title company, escrow company, or attorney who officiates the transaction, handles the signing of the mountain of paperwork, and makes sure all the money goes to the right places. They're the neutral third party that orchestrates the final handoff. Okay, take a breath. That's a lot. But we have one more category to cover: the prepaids. This isn't a fee. This is you paying for future expenses in advance. The official term for this section on your loan estimate is prepaids and other costs. First, you'll need to pay for your first full year of homeowner's insurance up front. The lender requires this to protect the property from fire, storms, or other disasters. You have to show proof of a paid-in-full policy before they'll give you the loan. Second, you'll prepay some property taxes. Depending on what time of year you close, the lender will collect enough money from you to ensure there's a cushion in your account to pay the next tax bill when it comes due. Third, and this one trips people up, is prepaid interest. Your first mortgage payment isn't usually due until the first day of the month after the month you close. So if you close on May 15th, your first payment isn't until July 1st. But interest on your loan starts accumulating the second you sign the papers. So at closing, you have to pay the daily interest on your $80,000 loan for the remaining days in the month of closing. In our example, you'd pay interest for May 15th through May 31st. All this prepaid money for insurance and taxes doesn't just disappear. The lender puts it into a special savings account called an escrow account. Then, each month, part of your total mortgage payment, your PITI, is automatically deposited into this escrow account. When your property tax bills and homeowners insurance premiums are due each year, the lender pays them for you on your behalf, using the money from that account. It's a forced savings plan that ensures the most important bills related to the house get paid, which, once again, protects the lender's investment. So let's tally it up for our $80,000 mortgage. A 1% origination fee is $800. Underwriting and processing might be $500. The appraisal $400. Title insurance and settlement fees could be $1,200. Add in the smaller fees and you're already at nearly $3,000. Then you have to add your prepaids, a full year of insurance and a few months of property taxes, which could easily be another $1,000 or more. Suddenly, that $4,000 estimate seems very, very real. This is the moment of truth for many buyers. They've saved for the down payment, but they weren't prepared for this second massive cash expense. It feels like a final insurmountable hurdle. But here's the secret. It's not set in stone. The question isn't just what these costs are, but which ones can you fight? Which fees are negotiable and which ones are fixed? And what are the secret strategies you can use to get the seller to pay some of these costs for you? Because slashing your closing costs by $1,000 or more is absolutely possible, if you know which levers to pull. So let's crack open this treasure chest of closing costs. Think of them in 3 distinct buckets. The first bucket contains your lender fees. These are the charges your bank or mortgage company bills you for the service of creating your loan. This is where you find things like the origination fee, which is basically their commission, the underwriting fee, which is the cost for their team to analyze your financial life under a microscope, and the processing fee for all the administrative paperwork. Now, listen closely because this is critical. This first bucket is the most negotiable. Lenders are in a competitive business. They want your loan. You can and absolutely should question these fees. When you get a loan estimate from lender A that charges a $1,000 underwriting fee, and another from lender B that charges $500, you have leverage. You can go back to lender A and say, hey, I'd love to work with you, but your competitor is $500 cheaper on underwriting. Can you match that? More often than not, they'll sharpen their pencil to keep your business. Never ever just accept the first set of fees they show you. The second bucket holds the third-party fees. These are costs for services required by the lender, but performed by outside companies. This includes the appraisal, where an independent appraiser determines if the house is actually worth what you're paying for it. It includes the credit report fee. It includes title insurance, which is a huge one. Title insurance protects you and the lender from any future claims on the property from long-lost heirs or unpaid liens from the previous owner. It's non-negotiable in the sense that you have to get it, but here's the secret. You can often choose the company that provides it. Your lender will give you a list of preferred providers, but you are not obligated to use them. The law gives you the right to shop around for your own title company or settlement agent. A few phone calls could save you hundreds of dollars on this single line item. Think of it like this. The lender says you have to buy a specific type of tire for your car, but they don't get to tell you which store you have to buy it from. Go find the best deal. The third and final bucket isn't really fees at all. It's prepaids and escrow funding. This is probably the most confusing part for first-time buyers. These are costs you'd have to pay as a homeowner anyway, but the lender makes you pay some of them upfront at closing. This includes your first year of homeowner's insurance premium. It includes any property taxes that are due, and it includes funding your escrow account. An escrow account is like a separate savings account that the lender manages for you. Every month, a portion of your mortgage payment gets deposited into this account, and the lender uses that money to pay your property taxes and homeowner's insurance on your behalf when they come due. Why do they do this? Because the house is their collateral. They have a vested interest in making sure the taxes are paid so the county doesn't seize the property, and that it's insured in case it burns down. To start this account, they need you to deposit a cushion at closing, usually a few months' worth of taxes and insurance. So while you can't negotiate your property tax rate, understanding that you need this cash up front is crucial for budgeting your total cash to close. So let's make this real with our $80,000 mortgage on a $100,000 house. Your closing costs, which typically run between 2 to 5% of the purchase price, might look something like this. In bucket 1, the lender fees, you might see a loan origination fee of 1%, that's $800. An underwriting fee of $700. A processing fee of $400. That's $1,900 right there just to the lender. In bucket 2, third-party fees, you'll have an appraisal for about $500, a credit report for $50, a lender's title insurance policy, which can vary wildly by state, but let's estimate $1,000, and various small fees like recording fees and flood certifications for another $300. That's another $1,850. And finally, bucket 3, the prepaids. Let's say your annual property tax is $1,800 and your homeowner's insurance is $1,200 a year. The lender will want you to pay the full first year of insurance upfront. That's $1,200. And they'll want to start your escrow account with, say, 3 months of property taxes, which is another $450. So you've got $1,900 in lender fees, $1,850 in third-party fees, and $1,650 in prepaids. Add it all up, and your estimated closing costs are $5,400. That's $5,400 in addition to your down payment. Seeing that number can be a gut punch. It's the moment where so many aspiring homeowners feel like the goalposts just got moved a mile down the field. But this is where we fight back. This is where we deploy the strategies that separate informed buyers from everyone else. We've already talked about negotiating bucket 1 fees with the lender and shopping for bucket 2 services like title insurance. Doing just that could potentially shave off $500 to $1,000. But now for the masterstroke. The single most powerful tool you have to slash your closing costs: seller concessions. A seller concession is when you, the buyer, ask the seller to pay for a portion of your closing costs. You write it directly into your purchase offer. And you might be thinking, why on earth would a seller ever agree to pay for my fees? It seems crazy, right? But it's not. It happens every single day in real estate transactions across the country. Here's the psychology behind it. Most sellers are not focused on the individual fees. They are focused on one number and one number only: the net amount of money they walk away with after the sale. So let's go back to our $100,000 house. Imagine you're low on cash. You have your down payment, but that extra $5,400 in closing costs is going to wipe you out. Instead of offering $95,000 for the house, you offer the full list price of $100,000, but you ask for a $5,000 seller concession. Look at the math from the seller's perspective. In the first scenario, they accept your offer of $95,000. In the second scenario, they accept your offer of $100,000, but agree to give you a $5,000 credit at closing. In both cases, the seller nets the exact same $95,000. It makes no financial difference to them. But to you? It's the difference between buying a house and continuing to rent. You were able to finance your closing costs into the loan without actually increasing your loan amount beyond the appraised value. You transformed a huge out-of-pocket expense into a slightly higher monthly payment spread out over 30 years. This is the ultimate lever. Now there are rules. Lenders cap how much a seller can contribute. For a conventional loan with less than 10% down, the limit is typically 3% of the purchase price. For our $100,000 house, that's a $3,000 maximum concession. For an FHA loan, it's a much more generous 6%. So when you write your offer, you and your real estate agent will craft the language carefully. Something like, buyer to offer $100,000, with seller to credit buyer 3% of the purchase price towards buyer's closing costs, prepaid items, and discount points. By using a percentage instead of a flat dollar amount, it automatically adjusts if the final price gets negotiated. Let's rerun the numbers with this strategy. Your total closing costs were $5,400. You negotiated with the lender and shopped for title, saving yourself, let's say, $600. Now your costs are down to $4,800. Then, you successfully negotiated a 3% seller concession, which is $3,000. The seller is now paying $3,000 of your $4,800 bill. Suddenly, the cash you need to bring to the closing table just dropped from $5,400 to just $1,800. That is a game-changing, life-altering reduction. It's the difference that puts keys in your hand. This single strategy is often the only reason many first-time homebuyers are able to clear that final hurdle. But getting the seller to pay your closing costs is only half the battle. Because the type of loan you choose can radically change everything we've just discussed. It affects your down payment, your mortgage insurance, and even the seller's willingness to accept your offer in the first place. Are you better off with a low down payment FHA loan that allows for huge seller concessions? Or should you fight to qualify for a conventional one that might have a lower long-term cost? The answer might save you tens of thousands of dollars over the life of your loan, and we're breaking down that exact choice next. Let's imagine you're at a fork in the road. To your left is a path that's a little easier to get onto. The gate is wide open, the ground is a bit softer, and it's designed to welcome as many people as possible. To your right is a path that's a bit more demanding. The gatekeeper checks your credentials a little more carefully, and you need to be in better shape to start the journey. The first path is the FHA loan. The second is the conventional loan. Both can lead you to the same destination, homeownership, but the journey, the cost, and the long-term experience will be vastly different. The FHA loan is the people's champion. It's a mortgage insured by the Federal Housing Administration, and its entire reason for existence is to make buying a home more accessible. Think of the government as your co-signer telling the bank, "Hey, we've got your back on this one. If this borrower defaults, we'll help cover the loss." This government guarantee makes lenders feel a whole lot better about giving money to people who might not fit into a perfect little box. What does that mean for you? First, the down payment. With an FHA loan, you can get into a house with as little as 3.5% down. On our $80,000 home, that's just $2,800. That's a game changer for someone who's great at paying their monthly bills but struggles to save up a huge lump sum. Second, credit scores. The FHA is notoriously forgiving. While conventional loans get nervous if your credit score is below 620, the FHA says, "Come on in." You can often get approved with a score as low as 580, and in some rare cases even down to 500 if you have a larger down payment. It understands that life happens, a medical bill, a past mistake, and it doesn't believe that should be a life sentence of renting. It's the loan of the second chance. But this accessibility comes at a cost. A very specific, very important cost. It's called mortgage insurance premium, or MIP. And the FHA has two flavors of it. First, there's an upfront mortgage insurance premium. This is a one-time fee, currently 1.75% of your loan amount, that gets tacked onto your mortgage right at the beginning. So on a $77,200 loan, that's an extra $1,351 that gets rolled right back into the principal. Your loan amount just got bigger before you even made your first payment. Then comes the second part, the monthly MIP. This is an ongoing fee you pay every single month, along with your principal, interest, taxes, and insurance. And here is the single most critical thing to understand about FHA loans today. For most borrowers who put down less than 10%, that monthly mortgage insurance payment is for the entire life of the loan. It never goes away. You could live in that house for 30 years, pay your mortgage on time every single month, and on payment number 360, you will still be paying that MIP. It's the price you pay for the low barrier to entry. Now let's look down the other path, the conventional loan. This is the gold standard of the mortgage world. It's not backed by the government. It's a straight deal between you and a private lender, like a bank or a credit union. Because there's no government guarantee, the lender is taking on all the risk themselves. So naturally they're pickier. They want to see a stronger financial profile. Typically, you'll need a credit score of at least 620 to even be considered. But the best interest rates are reserved for people with scores of 740 or higher. They'll also scrutinize your debt-to-income ratio more closely. They want to see a proven track record of financial responsibility. While you can get a conventional loan with as little as 3 or 5% down, the system heavily incentivizes you to bring more cash to the table. The magic number for a conventional loan is 20%. If you can put down 20%, you avoid mortgage insurance altogether. But let's be realistic, for many, that's a huge hurdle. So what happens if you put down less, say 5 or 10%? You'll have to pay something called private mortgage insurance, or PMI. It serves the same purpose as the FHA's MIP. It protects the lender in case you default. But here is the multi-thousand-dollar difference. Conventional PMI is temporary. It's designed to fall off. By law, once your loan balance drops to 78% of your home's original value, the lender must automatically terminate your PMI payments. You don't have to do anything. It just stops. You can even request to have it removed earlier, once you reach 80%, especially if your home's value has increased. This is the escape hatch that FHA loans simply don't have. So let's put this into practice with our $80,000 house. Let's create two buyers. Buyer A, will call him Frank, chooses the FHA path. He has a decent job but a credit score of 600 and has saved up $3,000. He makes a 3.5% down payment, which is $2,800. His starting loan is $77,200. The upfront FHA mortgage insurance of $1,351 is added, bringing his total loan amount to $78,000, $551. His monthly mortgage insurance payment will be around $36. Frank will pay that $36 every month for the next 30 years, totaling over $12,900 in MIP alone, assuming he never moves or refinances. Now meet buyer B, Connie. She chooses the conventional path. She's been diligent, has a credit score of 750, and has saved up $5,000. She decides to put down 5%, which is $4,000. Her loan amount is $76,000. There is no upfront mortgage insurance fee. Because her credit score is excellent, her monthly PMI is lower than Frank's MIP, let's say around $25 a month. But here's the key. In about 7 or 8 years, depending on her payments and property values, Connie will hit that magic equity number. Her $25 PMI payment will vanish. Poof, gone forever. For the remaining 22 years of her mortgage, she saves that money every single month. Over the life of the loan, she might only pay about $2,500 in PMI, while Frank pays over $12,000 in MIP. That's a $10,000 difference on an $80,000 house. So which one is better? It's not a trick question. Neither is better. They are different tools for different situations. The FHA loan isn't a bad loan. It's a get-in-the-game loan. It's for the person who sees a perfect $80,000 house in a neighborhood they love, and the math shows that owning it, even with MIP, is smarter than renting for another 3 years while they try to save more and fix their credit. It's a tool for building equity now. The conventional loan is the long-term wealth play. It rewards financial discipline with lower long-term costs. It's for the buyer who has the luxury of time and the benefit of a strong credit history. It minimizes extra fees and maximizes the amount of your payment that goes directly toward building your own wealth. So the FHA gets you in the door, but you pay for it forever. The conventional loan makes you work harder to get in, but rewards you for the rest of your stay. This seems like a permanent choice, a path you're stuck on for 30 years. But what if it isn't? What if the FHA loan isn't a 30-year sentence, but a short-term stepping stone? What if you could use the FHA loan to get into the house, and then once you're in, execute a brilliant move to get all the benefits of a conventional loan, ditching that lifelong mortgage insurance payment forever? This is not just possible. It's one of the smartest strategies for first-time homebuyers. But timing that move is everything. It's the difference between saving a fortune and wasting thousands on closing costs. And that is exactly how you turn the system to your advantage. So how do you actually turn the system to your advantage? You do it by understanding the one concept that banks and lenders hope you never fully grasp: the power of equity. Equity is the ghost in the machine of your mortgage. It's the invisible wealth you're building with every single payment, every single month. It's the portion of your home that is truly 100% yours, and it grows in 2 fundamental ways. First, every time you make that mortgage payment, a tiny slice of it goes towards the principal, the actual $80,000 you borrowed. The rest goes to interest, which is the bank's profit. In the early years, most of your payment is interest. It's a brutal reality. But that tiny slice that hits the principal, that's you slowly and methodically buying your house back from the bank. That's equity. The second way it grows is through market appreciation. This is the magic ingredient. While you're living in your home, painting the walls and mowing the lawn, the real estate market around you is constantly shifting. Ideally, it's appreciating, meaning the value of your property is going up, completely independent of your mortgage payments. This isn't guaranteed, of course. Markets can go down. But over any significant stretch of time in American history, real estate has trended upwards. This appreciation is like a silent partner, working in the background to increase your wealth. When you combine your own payments chipping away at the loan with the market lifting your home's value, your equity can start to grow exponentially. This is the engine of the starter home strategy. Let's make this real. Let's imagine a couple, we'll call them Mike and Sarah. They bought their first home for $100,000, putting $20,000 down. Their mortgage is exactly $80,000. On day one, their equity is $20,000, the amount they put down. They have a 30-year fixed-rate loan at 6.5%. Their principal and interest payment is about $505 a month. They plan to live there for 7 years. Let's fast forward. For 7 years, they've made their payments. That's 84 payments in total. They've paid $31,000 in interest to the bank. Stings a little to see that number. But they've also paid $9,500 towards their principal. So their original $80,000 loan is now down to $70,500. Their equity from payments alone has grown by nearly 10 grand. But that's only half the story. Let's say their local housing market has seen modest, conservative appreciation, just 3% per year. This isn't a crazy, unsustainable boom. It's a steady, believable growth rate. After 7 years of compounding at 3%, their humble $100,000 house is now worth over $122,000. Now let's do the math. The home is worth $122,000. They still owe $70,500. The difference is their equity. That number is $51,500. Think about that. They started with a $20,000 down payment. 7 years later, through a combination of their own disciplined payments and the quiet work of the market, they have turned that 20 grand into over $50,000 of real, tangible wealth. This is money they can now use. It is the key that unlocks the door to their next better home. This is the level-up moment that an $80,000 mortgage makes possible. But here's where most people get tripped up. They see that $51,000 number and think it's all cash in their pocket. And this is the critical, high-value information you need to understand. Selling a house is expensive. There are significant costs that eat into your equity. And if you don't plan for them, they can wipe out your gains and trap you in your starter home for longer than you intended. The biggest cost by far is the realtor commission. Typically, in the United States, this runs about 5 to 6% of the total sale price of the home. Not your profit, the entire sale price. So, on Mike and Sarah's sale of $122,000, a 6% commission would be $7,320. That comes directly out of their proceeds. Suddenly, that $51,000 in equity is down to about $44,000. But we're not done. There are other seller closing costs. These are the miscellaneous fees and taxes that most people forget about. They can include things like title insurance for the new owner, transfer taxes paid to the state or county, attorney fees, and other administrative costs. A safe estimate for these is usually 1 to 3% of the sale price. Let's be conservative and say it's 2%. That's another $2,440. So now, their take-home cash is down to about $41,500. And finally, you have to account for preparing the house for sale. A fresh coat of paint, fixing that leaky faucet, maybe some landscaping to boost curb appeal. Let's say they spend a modest $2,000 on these fix-ups. Now their final net, walk-away cash from the sale is $39,500. It's less than the $51,000 in raw equity for sure. And seeing those transaction costs can be demoralizing. But step back and look at the big picture. Mike and Sarah took their initial $20,000 investment and in 7 years basically doubled it. They turned 20 grand into nearly 40 grand, all while having a stable, affordable place to live. They effectively lived for a very low cost because their home was also a forced savings and investment account. That $39,500 is now the down payment for their next home. This is how you climb the property ladder. They aren't starting from scratch. They're not trying to save up 3% for an FHA loan again. They can now walk into a bank and look at a $300,000 home and say, "We have $40,000 to put down." That's a 13% down payment. It's a strong position. It means they'll likely avoid paying for private mortgage insurance on the next loan, which will save them hundreds of dollars every single month. It means they'll qualify for a better interest rate. It means their monthly payment on a much nicer, larger home will still be manageable. This entire strategy hinges on that initial $80,000 mortgage. Because the payment was low, they weren't house poor. They had breathing room in their budget. They could handle a car repair or a medical bill without panicking. They could still save a little for retirement. They had the financial stability to stay in the home long enough for appreciation to work its magic and overcome the transaction costs of selling. If they had stretched and bought a more expensive house from the start, one emergency could have derailed everything. This is the hidden genius of starting small. It's not about settling for less. It's about being strategic. It's about using your first home as a financial tool, a launch pad. You're letting time and the market do the heavy lifting for you. You are weaponizing your patience. But this transition from the starter home to the forever home is also filled with new and more sophisticated traps. The numbers get bigger, the stakes get higher, and the banks get even more creative with the products they offer you. When you're dealing with a $250,000 mortgage instead of an $80,000 one, the potential for a catastrophic mistake grows tenfold. And the single biggest danger isn't in the fine print of the loan. It's in your own psychology. It's the battle between your rational brain, which knows the numbers, and your emotional brain, which has already imagined your kids playing in the backyard of a house you can't really afford. With an $80,000 mortgage, the rational brain is almost always in charge. The numbers are small, the risks are contained, the decision is fundamentally a financial and logistical one. It's about shelter, stability, and a smart investment. But when you triple that number, the emotional brain hijacks the entire operation. This is where the most devastating mistakes are made. The first and most powerful psychological trap is what I call the dream home delusion. We've been conditioned by television shows, by social media, by our own family stories, to believe in the concept of a single, perfect dream home. It's not just a house. It's the physical manifestation of our success, our happiness, our identity. And when you find a house that seems to tick all those emotional boxes, logic flies out the window. Suddenly, the budget isn't a hard limit. It's a guideline. The non-negotiables, like a good school district or a reasonable commute, become compromises we can make. Imagine a buyer named Sarah. She's pre-approved for $280,000. She finds a house listed at $275,000. It has a beautiful open-concept kitchen and a garden that looks like it's straight out of a magazine. She falls in love. It's her dream home. But two other families feel the same way. A bidding war starts. Her rational brain is screaming, "This is too much. The comparable sales don't support this price." But her emotional brain is whispering, "If you lose this house, you'll never find another one like it. You'll be letting your family down. This is your one shot at happiness." So Sarah bids $300,000, then $310,000. To make her offer more attractive, she waives the inspection contingency. She wins. She gets the keys, feeling triumphant. A month later, during the first heavy rain, she discovers the magazine-worthy garden is actually a drainage nightmare, and water is seeping into the foundation. The repair estimate is $20,000. Her dream home has become a financial prison, all because she was chasing a feeling instead of analyzing a deal. Now, contrast that with a buyer named Mark, looking for an $80,000 property. The concept of a dream home doesn't really apply in the same way. He's not looking for a status symbol. He's looking for a solid, functional, affordable place to live. He finds a small 2-bedroom bungalow. It's not glamorous. The kitchen is dated. But the roof is new, the HVAC is solid, and the numbers work. There's no bidding war. There's no emotional frenzy. He has the time and the mental clarity to get a thorough inspection, which reveals a minor plumbing issue. He then calmly negotiates $5,000 off the asking price to cover the repair. For Mark, the house is a tool for building wealth, not the definition of his self-worth. The lower price point completely defused the dream home delusion. This leads directly to the second trap: fear of missing out, or FOMO. When you're in a hot market for more expensive homes, every conversation, every news headline, every post from a friend who just bought a house amplifies the pressure. Interest rates are going to rise. Prices in this neighborhood are up 10% since last quarter. You have to buy now, or you'll be priced out forever. This manufactured urgency is a salesperson's best friend and a buyer's worst enemy. It forces you to make one of the biggest decisions of your life on an artificially accelerated timeline. You rush through showings, you skim through disclosures, you submit offers on houses you've only seen for 15 minutes. You're not buying a house. You're desperately trying not to be the last one standing when the music stops. An $80,000 mortgage, however, often exists in a different universe. These homes are typically in markets that are less speculative, more stable. The frantic energy of a coastal city bidding war just isn't there. You have the breathing room to be patient. If one house doesn't work out, you know another similar one will come along. There is no sense that a once-in-a-lifetime opportunity is slipping through your fingers. This removes the panic and allows for methodical, rational decision-making. You're insulated from the collective anxiety that causes so many buyers of expensive homes to overpay. The third psychological danger is more subtle. It's the pressure of lifestyle expectations. We see our colleagues, our friends from college, buying 3,000-square-foot houses in pristine subdivisions, and we feel a deep subconscious pull to do the same. We start justifying our need for more. We need a guest room for when the parents visit, even though they visit once a year and could stay in a hotel. We need a home office, even though we work from a laptop on the couch. We need a 2-car garage, even though we only own 1 car. We aren't buying a house for our actual life. We're buying a house for the life we think we're supposed to have, the one that will look good on Instagram. This is how people with a $100,000 income end up with a $400,000 mortgage and no money left over to actually live. The $80,000 house is a powerful antidote to this pressure. By its very nature, it is a declaration of independence from those expectations. It's a conscious choice to prioritize financial freedom over square footage. It says, I care more about having the money to travel, to invest, to quit a job I hate, than I do about having a formal dining room that I will use twice a year. It forces you to be honest about what you truly need versus what society tells you to want. It's not a house of compromise. It's a house of priorities. These traps, the dream home delusion, the fear of missing out, and lifestyle expectations, all work together, creating a perfect storm of bad financial decision-making. They feed off each other. The desire for the dream home fuels the fear of missing out, which makes you susceptible to the pressure of lifestyle expectations, which convinces you that the dream home needs to be even bigger and more expensive. It's a vicious cycle that has trapped millions of Americans in homes they can't afford, living paycheck to service a debt they took on for emotional, not logical reasons. So we've identified the enemy, and the enemy is us. It's our own brain, hardwired with biases that push us toward financial ruin when the stakes get high. The good news? You can fight back. You can build a system, a personal protocol, that acts as a firewall against these emotional impulses. It's a set of non-negotiable rules that separates the smart buyer from the future foreclosure statistic. And that system starts with one surprisingly simple, yet powerful question. If I lost my primary source of income tomorrow, for how many months could I make this exact mortgage payment, plus taxes, insurance, and basic utilities, without selling a single asset or going into new consumer debt? That's it. That's the question. It's not about your credit score, your down payment, or even your debt-to-income ratio on paper. It's a gut check. It's a real-world stress test that cuts through all the noise and forces you to confront the brutal reality of risk. Because a mortgage isn't a one-time transaction. It's a 360-month commitment. That's 360 potential points of failure. A job loss, a medical emergency, a recession, an unexpected family crisis. Life doesn't care about your amortization schedule. The answer to this question reveals the strength of your financial foundation. For most people, the honest answer is 0 months. Or maybe 1. And that is terrifying. That's living on a financial knife's edge, where one bad Tuesday can unravel a decade of work. The system we're talking about, the personal protocol, is designed to change that answer. It's about building 3 distinct layers of financial armor around your mortgage, ensuring that when life inevitably throws a punch, you don't just survive, you barely even flinch. The first layer is your shield. This is your classic emergency fund. We've all heard of it, but it's the most misunderstood concept in personal finance. Your emergency fund is not a down payment fund. It's not a vacation fund. It is a hermetically sealed account with one job: to protect your lifestyle from a catastrophic loss of income. The standard advice is 3 to 6 months of living expenses. Not just mortgage payments, but everything. Food, gas, car payments, insurance, utilities, cell phone bills, the bare minimum you need to keep your life running. So, for our $80,000 house with a $650 PITI payment, if your total monthly nut, the absolute minimum to survive, is say $2,500, your emergency fund needs to be between $7,500 and $15,000. This money sits in a high-yield savings account, liquid and accessible, but not too accessible. It is your first line of defense. It's what you deploy when your income suddenly drops to 0. This fund is non-negotiable. It should be fully funded before you even think about closing on a house. Buying a home without this shield is like a knight walking into battle with no armor, hoping the dragon is in a good mood. But a shield isn't enough. A single heavy blow can still break through. That's why you need the second layer of armor. The chainmail. This is your home maintenance sinking fund. This is the layer that separates amateur homeowners from seasoned pros. While the emergency fund is for the unexpected, the maintenance fund is for the inevitable. Your water heater is not immortal. Your roof has a lifespan. Your air conditioner will fail, and I promise it will happen on the hottest day of the year. These are not emergencies. They are predictable, lumpy expenses. A true emergency is something you can't see coming. You know the roof is 20 years old. You know the furnace is making a funny noise. Treating these predictable failures as emergencies is a catastrophic planning error. It forces you to raid your real emergency fund, leaving your shield cracked and weakened for when a real dragon shows up, like a job loss. The rule of thumb here is to save 1% of your home's value annually for maintenance. For our $80,000 home, that's $800 a year, or about $67 a month. Sounds small, insignificant even. But here's the magic. You automate it. You set up an automatic transfer of $67 every single month into a separate high-yield savings account labeled home maintenance. You never touch it. Then, 3 years from now, when the HVAC company quotes you $4,000 for a new compressor, you don't panic. You don't put it on a high-interest credit card. You don't drain your emergency fund. You calmly look at your home maintenance account, which has quietly grown to over $2,400. You might have to pull a bit from other savings, but the catastrophic blow has been reduced to a manageable inconvenience. You've turned a financial crisis into a simple transaction. This fund is the unsung hero of homeownership. It's boring, it's slow, but it's the single best tool for preventing you from becoming house poor. So you have your shield, the emergency fund, and your chainmail, the maintenance fund. But what about a direct, piercing blow? A surprise attack you never saw coming? That's where the third layer of armor comes in, the helmet. This is your peace of mind buffer. This isn't a formal fund with a percentage rule. This is the extra cash you keep on hand that insulates you from life's smaller, but still painful financial shocks. What happens when your city reassesses property values, and your tax bill suddenly jumps by $80 a month? That's almost $1,000 a year you didn't budget for. What happens when your homeowner's insurance premium mysteriously increases by 20%? Or the HOA levies a special assessment for a new community fence? These things happen all the time. They aren't big enough to trigger the emergency fund, and they aren't technically maintenance. But they can bleed a tight budget dry. The peace of mind buffer is a few $1,000s, maybe 1 or 2 months of mortgage payments, that sits in your primary checking or savings account. It's your shock absorber. When that surprise tax bill arrives, you don't have to rework your entire budget. You don't have to cancel your kids' swim lessons. You just absorb it with the buffer, and then you adjust your budget moving forward. It removes the stress and anxiety from the financial friction of homeownership. It's the difference between hearing a strange noise in the basement and thinking, "Oh great, what now?" versus thinking, "Okay, let's see what it is. I've got this handled." So let's put it all together for our $80,000 mortgage. Before you sign the closing papers, your financial armor should look like this. Layer 1, the shield. A $7,500 to $15,000 emergency fund, untouched in a separate account. Layer 2, the chainmail. A home maintenance fund, also in a separate account, with an automatic $67 monthly deposit. Layer 3, the helmet. A $1,500 to $3,000 cash buffer in your main accounts to handle the unexpected monthly fluctuations. When you have this system in place, your answer to that initial powerful question changes. If I lost my job tomorrow, how long could I last? The answer is no longer 0 months. It's 6 months, maybe more, without even breaking a sweat. You have fundamentally transformed your relationship with risk. The mortgage is no longer a source of fear. It is simply an expense, managed by a robust, resilient system. You've stopped being a homeowner who is owned by their house, and you've become a homeowner in complete control. But this bulletproof defensive strategy is only half the equation. Because once your defenses are set, the real game begins. The game isn't just about surviving your mortgage. It's about making your mortgage make you rich. And the playbook for that is something the banking industry rarely talks about, because it involves paying them as little as humanly possible. Let's open that playbook. The first page, the one that's dog-eared and highlighted, is called the Snowball of $100. Your lender gives you an amortization schedule. It's a precise, cold calculation of how every single one of your payments is split between principal and interest over 30 years. In the beginning, it's brutal. That $500 payment might see less than $100 actually go toward owning your home. The rest? Pure profit for the bank. But this schedule is also their biggest weakness. It's calculated on the assumption you will only ever pay the minimum. The moment you pay $1 extra, you throw their entire 30-year spreadsheet into chaos. Let's say you find an extra $100 a month. You skip some takeout, cancel a subscription you forgot you had. You take that $100 and you apply it directly to your principal. You have to be specific with your lender. This is for principal only. On our $80,000 loan at 7%, that extra $100 a month will save you over $31,000 in interest. Let me say that again. You pay an extra $100 a month, and the bank gets $31,000 less of your money. Even better, you will own your home free and clear more than 8 years sooner. Think about that. For the price of a nice dinner for two each month, you get nearly a decade of your life back without a mortgage payment. That is the power of breaking their schedule. The next play is a variation of this called the bi-weekly blitz. A lot of people misunderstand this. They think paying half your mortgage every 2 weeks is the magic. It's not. The magic is in the calendar. There are 52 weeks in a year. Paying every 2 weeks means you make 26 half payments. 26 half payments equals 13 full monthly payments. Not 12. You sneak in one entire extra payment a year broken up into tiny painless pieces. That one extra payment, just like the $100 snowball, goes almost entirely to principal, especially in the early years. It attacks the core of the loan, accelerating your equity and cutting down the interest-generating machine. Again, on our $80,000 loan, this strategy alone can shave about 5 years off your mortgage and save you thousands. A word of caution: never pay a third-party company to set this up for you. They just take your money, hold it, and charge you a fee for something you can do for free. Call your lender or set it up through your own bank's bill pay. You control the blitz. Now for a more advanced move. Let's say you get a bonus at work, an inheritance, or you sell something valuable. You have a lump sum of cash, say $10,000. The amateur move is to just throw it at the mortgage. That's good, but it's not great. The professional move is called a mortgage recast. This is one of the best-kept secrets in personal finance. Instead of just reducing your principal and continuing with the same high payment, you ask your lender to recast or re-amortize the loan. They take your new, lower balance and recalculate your monthly payment based on your original interest rate and remaining term. So, you drop 10 grand on your $80,000 loan. Suddenly, your principal is under $70,000. After a recast, your monthly payment of around $532 could drop to something like $465. That frees up nearly $70 a month in cash flow. Why is this so powerful? Because it gives you options. You can take that newly freed up cash and invest it elsewhere, in the stock market, in a retirement account, or save it for another down payment. Or you can continue to pay your original, higher amount, now with that extra $70 going straight to principal, creating an even more aggressive paydown strategy. A recast gives you flexibility, the most valuable commodity in finance. It costs a couple $100, way less than a refinance, and you keep your original, hopefully lower interest rate. But paying off your mortgage is only half the game. Remember, the goal isn't just to be debt-free. The goal is to be wealthy. And this is where we turn your simple $80,000 house from a liability into a cash-generating engine. Once you've paid down a significant portion of your loan, say you now owe only $50,000 and the house is worth $100,000, you have $50,000 in equity. To most people, that equity is just a number on paper. It's dead money sitting inside your walls doing nothing. But to the wealthy, that equity is a sleeping giant. And you wake it up with something called a home equity line of credit, or a HELOC. A HELOC is a revolving line of credit, like a credit card but secured by your house. The interest rates are usually much lower, and the credit limit is substantial. You don't take it all out at once. You get it approved and it just sits there waiting. It's your war chest. It's your opportunity fund. Suddenly, another $80,000 house comes up for sale down the street. It's a foreclosure, a great deal, but you need a 20% down payment of $16,000 in cash, and you need it fast. While everyone else is scrambling to sell stocks or apply for loans, you tap your HELOC. You write the check. You buy the property, fix it up, and rent it out. Now you have a tenant whose rent payment not only covers the mortgage on that new property, but also pays back the HELOC you used, plus puts extra cash in your pocket every month. You just used your first house to buy your second house. And you did it without saving up for years. You deployed your lazy equity. That is how real estate empires begin. Not with millions of dollars, but with one small, smartly leveraged property. Your $80,000 house is no longer just a roof over your head. It's the headquarters of your financial future. It's the bank that you own. And that brings us to the final, most important part of this entire journey. It's not about interest rates or down payments or even property taxes. It's about a fundamental shift in your mindset. For most of our lives, we are taught to see a mortgage as a burden, a 30-year ball and chain, a necessary evil. We are told to get a good job to afford the payment, to work hard for 3 decades just to finally own something. This is the consumer mindset. It's a mindset of survival. But there is another way to see it. The investor mindset. The investor sees the $80,000 mortgage not as a 30-year sentence, but as a 30-year loan from a bank at a relatively low interest rate, that allows you to control a valuable, appreciating asset. You are using the bank's money to build your own wealth. This small, manageable mortgage is your training ground. It's where you learn the discipline of making extra payments. It's where you learn the strategy of using equity. It's where you prove to yourself, and to the financial world, that you can successfully manage debt and leverage it to your advantage. Mastering an $80,000 mortgage prepares you to master a $150,000 mortgage on a duplex. Mastering that prepares you for a commercial loan on an apartment building. It all starts here. In that small town, in that starter home, with that payment that seems so insignificant in the grand scheme of things. What a $80,000 mortgage looks like in the end is whatever you decide it will be. It can be a simple, affordable roof over your head in a quiet American town. And there is absolutely nothing wrong with that. It is a beautiful, worthy goal. But it can also be the first purchase order for your future empire. It can be the launch pad, the key that unlocks doors you never even knew existed. The question was never, can I afford this? The numbers showed us that for many the answer is yes. The real question, the one you should be asking yourself tonight is, what am I going to build with it?